welcome. I am Piers Ridyard, CEO of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Oliver, founder and CEO of InsurAce. InsurAce is the leading decentralized insurance protocol, providing reliable, robust, and secure insurance services to DeFi users, allowing them to secure their investment funds against various risks. Oliver, thank you so much for coming on the show.
Thank you, sir. Thanks for having me today. It's really been a pleasure, to come here. Yeah.
Awesome. So just talking about InsurAce, obviously you guys are not the first people on the market. I think the one of the oldest ones in the space, Nexus Mutual, some people will be aware of. But if you could just talk a little bit about what InsurAce does and sort of what makes it different from what's come before.
Yes. Yeah, sure. Yeah, definitely. I think you guys have heard a few of other, DeFi insurance protocols like what you have mentioned, Nexus Mutual, and I think another typical insurance protocol is Cover.
Yep.
Yeah. So I think basically they are doing different models. So Nexus Mutual is basically it's a mutual insurance, whereby Cover is a peer-to-peer, insurance protocol. Whereby I think we are different, but we are more of like the model of Nexus Mutual. Basically, we are capital pool based, whereas Nexus Mutual is also a capital pool based because they will form a mutual pool. On top of the pool, they will provide insurance services. But for us, we are not really mutual insurance, but instead we're more of like some kind of a capital pool based insurance, but we got the capital pool based on people staking, and we use this staking to form the capital pool, and on top of the capital pool will be able to underwrite the insurance risk and provide insurance products and services. So I think a few key differentiators like between us and Nexus Mutual is like what we can offer is a portfolio-based coverage, whereby on Nexus Mutual you are more of buying coverage per each one of the protocols. Let's say because you're farming on Curve, you're farming on Convex. If you want to also, let's say you're farming on Ethereum protocol. So if let's say in Nexus Mutual's product, let's say if you're farming from like EM protocol to Curve, then you have to buy them separately, buy the 2 times, whereas on our protocol you can just buy it in one shot as a portfolio, which will save your premium, will also save your gas fee. So this is one of the major difference for us in terms of the product. Whereas there are quite a few different designs here, like on Nexus Mutual, the staking is a per protocol basis, whereas we're doing an aggregated pool, so which will provide much larger capacity for each one of the protocols. And also you can see we also have the investment arm, which is to generate higher returns for the users as well. And also we're going to provide the cross chain coverage as well. So we launched our cross chain coverage. We won in May this year, and just in last Thursday we launched our BSA version. So we are just providing a cross chain coverage from a virtual multi-chain product to a real cross-chain product. So I think that's some of the things we have been providing and kind of different from Nexus Mutual. Yeah.
Super interesting. So like just starting from basic principles, you guys are covering the risk of a DeFi application getting hacked, or there an exploit occurring or something like that. I think to date we've had something like $285 million or $300 million of hacks in Ethereum in the last 2 years. So the idea is that you can cover the risk, that not that you lose your investment because the investment goes bad, but you lose your investment because a hacker works out a way of being able to exploit the underlying application code. And you're different from what's come before because your model sounds a little bit more like an actual insurance company. You essentially capitalize the smart contract with capital that can write risks. You determine what those risks are and therefore the capital adequacy for those risks. But you don't have to add it protocol by protocol. You can just go, right, we have a block of capital that we can write risks against.
Yes, exactly.
So from the point, and then the last thing, your investment strategy, which again is quite insurance-like in that many insurance companies take the premiums they get paid, and they have a capital reserve, and then that capital reserve they invest to get a yield, so that they can make money. They can make money on the capital that's being held and is waiting, that is covering potential payouts. From the point of view of I think the hardest point here, right, is working out what the risk is in the first place, like how much capital you need to put against it, and how and whether you can write the risk. So how does InsurAce actually do that?
Yeah, sure. You're right. So the basic risk we can cover at the moment, there are three different risks. One is a smart contract risk, which, as you mentioned, like the smart contract bugs, smart contract vulnerabilities, exploits by hackers. So we're covering that type of risk for most of the protocols. The second type of risk we can cover at the moment is called centralized exchange or custodian risk. Let's say there are a few, centralized exchanges like Huobi, Binance, or Coinbase. So there could be risk for those exchanges as well. And the third kind of risk we're covering is called IDO event risk, which is the first one we are offering in the industry. Let's say there are various kind of IDO events up there in the industry. New projects are doing IDOs, whereas there could be also security risk during the IDO events as well. So we're providing insurance for that type of events as well.
So IDO standing for Initial DEX Offering, right? So
Yeah,
like
exactly.
offering a new token on something like SushiSwap or Uniswap. What's the kind
Yes.
of risk that's associated there? What are you covering in an IDO risk event? What's an example of that you would pay out against?
Yeah, so one of the example is that in last month, we worked together with an ideal platform called Pentolaunch, which is a kind of a sub project of Dollar Factory, another project. So what we do is like during the IDO event, there could be security hacks as well. So which the hackers will move away the IDO funds from the IDO platform, whereas we can ensure for that specific IDO event, which there are two benefits for the project teams who buy our insurance. One is definitely we can cover the security risk, safeguard their funds. On the other hand, we're actually kind of providing the credibility, the kind of confidence from the insurance project side. So these are the things that or value add we can provide to the IDO projects.
So the IDO risk is during the fundraising process. You can have a hack or an exploit. Has that happened before? Is that something that happens regularly?
Yeah, I think it's not something happen regularly. Of course, it's just like the smart contract risk, right? It doesn't happen, frequently, but it does happen every now and then, for some protocols. But every time it happens, it's a big hit, for those projects. So there was one case happened to one of the IDO events back to, I think it's March on Dodo, one of the DEX. So there was a hack into Dodo in their ideal event as well. So in such case, because the projects who come to do the ideals are mostly new projects. They are kind of small, they're kind of new, and they really need the fundraising to be secured. So let's say if something happens, and then it might not be something big for for those big projects, but it's definitely something, a big damage or a big negative impact to those new projects. Yeah.
So from the point of view of something like, let's take a simple example of a smart contract risk.
Yeah.
And if I'm a liquidity provider on, let's take an example, Uniswap V3. Uniswap V3 recently come out. I've decided that I'm going to be a liquidity provider on Uniswap V3, but because it hasn't been around very long and I want to put a large amount of liquidity in there, I might feel a little bit hesitant about that. Maybe like don't want to put so much in, but I realize that if I go in early and I go in big, I'm probably going to get a bigger return. So I have an incentive to be early and to go in at size. And what InsurAce is allowing you to do is cover the risk of a hack or an exploit, meaning that I lose my funds on Uniswap V3. How do you work out how that should be priced?
Okay, yeah, sure. So actually, after the Uniswap V3 is launched, we are kind of the first one, to list it, Uniswap V3 onto our insurance portal. So let's see how we price this kind of risk is that we will do risk assessment, on the Uniswap V3. Of course, for some of the projects, we can get the information from the project team directly. So we have a very thorough, questionnaire for the project teams to provide all those kind of, security auditing, operation history related answers. But for Uniswap V3, they are pretty much new and they are pretty much big. So what we can do is we, gather all this information that we can get on a best effort basis from the public channels, and then after that, because they are open source, so our technology experts will come in, to read the code and see, and also read their auditing reports, and after that, we'll give an estimation on their, security status, and after that we can decide on the premium, and that's the first step for pricing. I think the second step for pricing is since we're offering a portfolio based coverage, right? Let's say if people are covering Uniswap V3 plus some other V3, their surrounding applications, so that can make into a portfolio. So we will calculate like the correlation between V3 and all the other protocols. So we got a big correlation matrix, and from there onwards, we can do the portfolio-based, coverage pricing. Yeah, right. So that's basically how it works.
And that's critical because in DeFi, you have protocols or applications relying on other applications, right? So I can have my Uniswap V3, and then I could be farming using, Harvest Finance, and Harvest Finance will have a Uniswap V3 curve strategy. And for you to be able to price that, you need to be able to have priced Uniswap V3's risk, Curve's risk, and Harvest Finance's risk all together to then give you an aggregate policy price, right?
Yeah, exactly. So what we do here is that we'll take different factors into the pricing. Like we'll take into the staking factor. Of course, the larger our capital pool is, the more staking. Essentially the lower the risk. Then the second factor we're taking into consideration is called an aggregated expected loss, which is an professional term in the actuary science. So
sorry, say that first one again. You said that the larger the staking, the lower the risk.
Yeah, that's let's say, because for insurance, right, the more capital you got, right? So the lower the risk, it's not from the project teams, from Uniswap V3's perspective, but more from our perspective, because we got a larger capital pool to underwrite the risk, right? So of course we'll take that factor into consideration, right? So then the second one is that we will really do an estimation on the potential aggregated loss, which we call aggregated expected loss, which is an professional actuary science term. So on top of that, we'll come in with a basic pricing of the portfolio based coverage.
Got it. And so from the point of view of to actually write cover in the first place, you have to already have onboarded that application, right? So you have to have gone. So I can't come and buy cover for Harvest Finance if you guys haven't already done the assessment of Harvest Finance for obvious reasons. So you were talking about this sort of like total cover, like reduced gas price of being able to take things in aggregate. So me as a user, how's that work for me? If I've got cover for Uniswap V3 and I decide to move that liquidity from Uniswap V3 to Harvest Finance Uniswap V3 strategy, how's that work in terms of, do I then just get charged the difference with you guys, or like how's that work in terms of my policy coverage? Do I have to buy a new policy for that, or do I get to just change the policy parameters and just pay a little bit more as a result?
Yeah, so let's say if you're doing liquidity mining on Uniswap V3 and plus Harvest, right? So what you need to do is is that, okay, so you need to, let's say if you want to safeguard your funds on Uniswap V3, then you need to buy insurance for Uniswap V3. And if you want to buy them together, you need to put Harvest plus Uniswap V3 into a portfolio and buy them together. In this way, you're actually securing the end-to-end cycle of your farming process. Yeah, and then what we can do is, let's say if there is hacking happens to like Harvest, but let's say you didn't buy insurance for Harvest, right? Then we cannot claim for your loss. So yeah, so on and so forth. Yeah.
Okay, and then so from the point of view of capital coverage, right? Like in traditional insurance, you can only write as much coverage as you have capital adequacy, and there's a bunch of really strict capital adequacy rules around insurance and all this kind of stuff. However, in DeFi that doesn't exist. So how do you guys work out? I mean, it doesn't exist from the point of view of there's no rule set yet. So how have you guys decided what the right level of capital adequacy is, what the probability of correlated events are, right? Like a lot of these things are really connected, and if you find you could have very connected claims and all this kind of stuff. How have you worked that through and come out with something that you guys are comfortable with from a risk capital point of view?
Yeah, good question. I think that's one of the key, challenges for designing a DeFi insurance protocol. Yeah, so basically there is a pricing we have just discussed, and about the capital management. So we need to make sure that we always have sufficient reserve in place to counter, to handle the potential claim payouts.
Right.
Let's say if there is something happens, we need to handle claims. So but we always need to reserve enough capital, right? So in this regard, we're borrowing kind of experience from the traditional insurance industry. So there is an international standard called Solvency II capital requirement, which is widely adopted in Europe. So it's kind of a industry standard. So we're borrowing experience from that standards as well. So they have kind of a very full set of capital management methodologies, approaches on, let's say, based on how much cover you have sold, how much cover have expired, and how much claims are during in the process, and how much we need to reserve for the future potential claims. Combine all this together, we'll come up with like a minimum capital requirement we need to have. Then on top of that, we need to decide how much capital we must put into place, for the potential claims. So basically, we are kind of following the best practice in the traditional insurance industry, but more of borrowing it, integrating it with DeFi practices. Let's see the kind of capital requirement, what we call SCR, called the solvency capital requirement, which is to guarantee that this insurance entity will not go bankruptcy on a confidence interval of 99.5% during 12 months. So we need to meet that requirement. So let's say that kind of requirement, capital sufficiency requirement, is calculated like monthly or quarterly in the traditional insurance industry. But for us, we're basically calculating it on a daily basis, or we can even do it more frequent. Let's say every 4 hours or so. So because of most of the data in the blockchain industry on Ethereum are just transparent. It's just public there, so we can definitely use all this data. And I think another angle you just asked about, I think it's very insightful, is a lack of data. In the traditional insurance industry, you have enormous amount of data. You have the big data set, whereby you can run all of your models on top of this data, and
Right.
you can predict the probability of a serious disease, and then on top of that, you can sell your covers.
Right.
Whereas in DeFi or in crypto industry, there is not so much data, right? So it's hard for us to do everything based on the models or based on the data, right? But what we can do is that we'll definitely have some models, to run the backtesting to do. But because of the scale of the data we have, they're not very very big. So what we can do is we utilize all the data we have to run the model. On the other hand, we need to utilize the insurance experts experience, which we call actuary judgment. So that's why it's very important to have a very experienced actuary expert in the project. So I mean, what I can tell you is that all models are wrong, man. All models are wrong, but some of them are useful, you know. So we have to utilize the models we already got and plus the actual judgment and combine these two together. You know, we can come up with a pricing strategy and the capital management methodologies. Yeah.
Right. Okay. And so from the point of view of, yeah, I mean, like the capital adequacy rules are always the most important ones for any insurance. Like in life insurance, I think it's the 100-year test, right? Like if you're a life insurer, your company has to at any point have sufficient capital to withstand the worst potential catastrophe
Yeah.
perceivable within 100-year time frame, right?
Yep. Yep.
Obviously, DeFi moves quicker, and so you're not actually insuring someone's life. You're insuring the lifetime of someone sitting in a protocol, which could be 6 months.
Yep.
But let's talk about from a capital point of view, like from the people who are staking to InsurAce, like they have to want to do that because the InsurAce is providing them a return. So how does that side of things work? How do you attract capital so that you can write cover, basically?
Yeah, sure. We are carrying out in two phases. So currently we're in phase one. So in phase one, we are attracting the capital to come in to underwrite the risk with our governance token, our native token as rewards. So which is quite common for almost for every DeFi project. And in phase two, so I think we're very soon to enter into phase two, which we will, put our premium into the reward system, so that every time people come into stake to provide the capital for insurance underwriting, then they will get two parts of rewards. One is our token rewards plus a sharing of the premium earned. So in this way, because let's say if you always use your tokens as rewards, it's definitely not sustainable. What if after 5 years, after 7 years, your tokens run out, right? So we need to price in some other things like the premium or the investment returns into the reward system, so that this is something that I think is sustainable. Yeah, but because at the very early stage of the protocol, so we do not have any premiums at all. So currently we have sold out more than 22 million of covers, and we have earned more than 70K of premium. So we have got some premium in a pool. So we will start to roll out, sharing of the premium to the staking users. Yeah, that's our approach.
And in terms of like buying cover from the point of view of the user, is this something that I can do in a single transaction? Is this something where I can be like, okay, I'm going to input liquidity into Uniswap V3 and at the same time buy that amount of cover equal to my Uniswap V3 liquidity add with InsurAce?
Yeah, that's something in our roadmap, but at the moment it's not available. So basically, that's what we're going to do next. We're going to provide an API. So basically, you see, one of the beauty things about DeFi is its composability, right?
Right.
Different DeFi projects, they can integrate to each other, interoperate with each other, and function at the best effort. So what we are going to do is we'll provide a set of APIs. So we provide insurance as a service. So let's say other protocols can always call our API to get our service. So it's not just about Uniswap V3, but there are other protocols like DBank or Dapper, all those aggregator. That's actually one of the best scenarios, to integrate with our services. So let's say next time when you are doing staking while DBank, right? Then in the process of your staking, then there will be an option for you. Hey, you want to get insured? If you tick that box, then you get insured. Plus, you get staking, right? All this will done in one transaction, which will definitely save your efforts, save your gas fee as well. Yeah,
Right.
I think that's something we're going to develop and provide subsequently. Yeah.
It's what we already see in the traditional sector, right? You're buying a
Yep.
flight, and you
Exactly,
just say,
man.
oh, yeah, I want flight insurance. And
Yep.
like the same thing here to get to that. And like DeFi lends itself to that because it is so wonderfully
Yeah.
composable. You can call 50 smart contracts in one transaction.
Yep.
So let's talk about your multi-chain strategy, because that's from a point of view of an insurance application, that's an interesting challenge as well, right? Because you have the place you're writing and taking the premiums as different from where the capital that is covering those premiums is being held. And I can see how that might be easy in some ways and what might be challenging in others. So like, could you talk a little bit about what the first chains you've chosen are, and like how the cross chain system works from the point of view of getting premiums out and then into the pool, and then divvying them up amongst the people who have provided capital?
Yeah, definitely. So multi-chain is a big direction for us, to develop into. So basically, we started this, back to May this year. So in the middle of May, we launched our, multi-chain insurance waypoint zero. So in this version, we are relying on our current Ethereum deployment, but standing on Ethereum, we can provide coverage to users' assets on other chains from Ethereum to Polygon to BSC, to Solana and Phantom and even Terra as well. So as long as people they have assets on these chains, although they are not interoperating with Ethereum, but as long as they have assets on those different chains in these protocols, and they can provide proof of assets when the claim comes, then we can we can offer the coverage for them. So this is what we call the multi-chain way 1.0. And currently we deployed our new version to BSC last Thursday. So in this way, we are expanding our footprints to physical deployments on other chains as well. In this way, so let's say people on BSA can just use our service as well. So this is what we call multi-chain way 2. And in way 3, I think we're going to offer kind of an aggregator. So let's say next time if you want to buy insurance, right, you do not need to differentiate between whether you're on BSA or on Ethereum. So at the back end, all the capital pools, the capacities are aggregated. So you just input, let's say, hey, I want to buy like 50K of insurance for Uniswap V3, then we will have a smart aggregator which will automatically find you where their capacities are, and buy the coverage for you there. Let's say if you do not have enough capacity on Ethereum, then we will help you buy the coverage on BSA because we got more capital on BSA, for example, right? So we are doing this cross-chain insurance in 3 versions, 3 stages. Currently, we're in stage 2, and I can tell you we have deployed to BSA, and we're also looking at layer 2 solutions, of course, Polygon, included. So at the same time, we're also, we have participated in the Solana hackathon, and also we have applied for the Solana, official grant. So Solana is also another chain we're taking, deep look at as well. Yeah. Also, I think just to mention, because Alameda, invested in us, so we kind of got a good connection with, Solana side. Yeah.
So with regards to actually like deploying on a multi-chain setup, what you're suggesting is each chain will essentially have its own capacity,
Yeah.
its own capital pool that it can write insurance contracts from, and eventually you'll be able to aggregate between. What about underlying? Where does the protocol risk itself like run? So like, let's say that Solana, which isn't formally verified as a consensus algorithm, turns out it's got a massive problem with it. Turns out that it isn't safe, and it stops working and it can't be reset for whatever reason. Like, what does that get calculated in when you look at multi-chain as well, or is that the protocol risk not calculated in a payout? Because that would mean obviously that your liquidity was also gone if you'd provided liquidity to say Serum on Solana. Like,
Yeah.
what would that look like as a payout? Would the failure of the underlying protocol also mean a payout or not?
Yeah, we are actually pricing that type of risk into the product itself. So if you took a look at the risk assessment questionnaire I mentioned, you will see that the chain type is one of the factors we will take into consideration when we are evaluating, the risk for each individual protocol. Let's say, I think back to last few weeks, there are a lot of security incidents on BSC. So we
Right.
essentially, lifted the risk level for BSC projects. So you can see that the projects on BSC are kind of have a much higher premium than those on Ethereum. So these are one of the factors we'll take into consideration for sure. Yeah.
Right. And if the chain itself stops and the capital is not available, does that mean that I mean, this is a complete worst case scenario, but let's say that Solana stops, that some of the premiums, some of the capital is, oh no, because you underwrite the capital using your governance token, right?
No, not just governance token. We also accept a range of different tokens from ETH to WETH to
Right.
DAI, USDT,
Right.
USDC, and probably we just had a partnership with MStable last week, so we're going to add in MUSD from
Yeah.
MStable into our staking assets as well. Yeah.
Right. Okay. So if the asset is an off-chain asset, then that's less risk. But if it's the native token of the platform and the platform has a problem and it goes to zero, that also has an interesting risk characteristic as well. I'm just thinking out loud because it's such a fascinating area, because it's not just the protocol risk as in the application risk, but it's also the layer one protocol risk as well, which is something that we think plenty about.
Yeah, you're right, man. Because let's say if Solana stops work, BSA stops work, right? I think this is something that we cannot cover or insure, because this is kind of a systematic failure, right? So let's say if BSA stops, other protocols on BSA will not work. So I think that's too much for us to cover, man. Yeah.
Okay, and so in terms of like long-term thinking here, where do you think insurance is going to get to in this space? What do you think the future of decentralized finance insurance could look like in the most bullish or optimistic cases?
I think I would say first, let's say on the market scale. Okay, so currently, let's say we have seen over 100 billion of TVL in DeFi, but let's say but less than 2% is covered by insurance. So I think I can give you that number, but I have really talked to a lot of the friends, the sideway people, players in the DeFi space. Basically, will agree that let's say I think 80%, 8% or 10% of all the DeFi values get covered by insurance is kind of a reasonable number to go. Okay, so I can see there is still a lot of space for DeFi insurance protocols to grow. So that's on the market skill set. Whereas I think on the coverage side, I can see that insurance will function like, as I just mentioned, like a infrastructure layer of service for many DeFi protocols, like linear borrowing or DEX. Then let's say you would kind of always need to integrate with insurance protocols as a basic layer or service you have to offer. Let's say even for now, for many of the DeFi protocols, no matter they are doing Indian borrowing or they are doing like some derivatives, most of the protocols will need to integrate with some kind of AMM functions there, right? So I think I should say in a way, AMA functions has been one of the basic infrastructure layer of service for many protocols. So that applies to us as well. Let's say we probably will integrate with Uniswap V3 the swap functions there. So let's say anytime we got some premiums, let's say I want to do some buyback of our tokens, then I will need to integrate with Uniswap V3 swap functions. So I think insurance will become a basic infrastructure layer of service for the whole DeFi space, and so that's on the coverage side. Whereas I think going forward, I can say that insurance will play a big part, for the whole DeFi space, as there will always be, a lot of security incidents there. Of course, you can do audits, you can do auditings, you can do bounties, you can enhance your systems, but one thing you need to pay attention is that insurance is there to cover you up. Okay, so just like last time I was in an interview, then the people asking me, "Hey, we got bug bounties, we got very strong engineering team. I got auditing, I got 4-5 times the audience. Why do I need insurance?" So I see, hey, you need to pay attention that in DeFi is kind of like the Wild West. So you always work for the best, but you prepare for the worst. Right. So let's say you do auditing, you do bug bounties, you do technology enhancements, but these are things you essentially need to do. You are working for the best. But let's say anything bad happens, who is going to take the obligation for you? Who is going to cover you up? That's insurance. Insurance will take the hot cold cash out to to compensate you. So I think that's a real value of insurance services, right? For most of the auditing firms, they will help you do your code review. They'll help you, find the bugs. But after that, they will not take any obligations. Even if for some of the protocols they have 3 times or 4 times or 5 times of auditings, but it's still stand the risk of getting hacked. Then once you got hacked, who is going to help you?
Right.
They will not. But insurance is always there, to really, really give you some, real support.
And I think that like even in the high risk environment that DeFi is, insurance is not so expensive that it doesn't make sense, right? Like if I'm getting 15% per annum from investing in a yield strategy on Harvest Finance, or on another of the available, on Yearn or whatever it is, what's it going to cost me? 2%, 3% per annum to insure that?
Well, it depends on the risk assessment on the protocol. Let's see for some of the big, established projects like Aave or Uniswap V1, V2. Currently the premium is like around 2% to 2.5%, so which is very low. Let's say for some of the high risk the projects with a bit of high risk, then the premium could be like 4 or 5%.
Sure, but like if you're getting 20% per annum or 30% per annum on a high risk strategy, that's bringing your risk return, so your risk substantially down whilst maintaining a pretty high return. And I'm not going to say it's risk free, because it's not, right? Because fundamentally,
it's not.
InsurAce isn't risk free. Like the systems themselves, you're talking about systemic risk of system, like those exist as well, like a 51% attack on Ethereum when it moves over to staking from proof of work, or like a safety break or whatever. Like it's all new technology, it's all in flux. But I think that historically speaking, the most likely thing to happen to a smart contract is an exploit. And if you've got coverage of that, even if it's slightly reducing your returns, you're massively increasing your risk-adjusted returns.
Yes, exactly. So let's say you got more than 10% of APY, right? Then you spend 2.5% on the insurance side, whereby, so I think, why not? Right. So without the insurance, you could be in sleepless during some of the big events. But let's say if you got insurance, you always got someone to cover you up. So you can just sleep well during the night. Yeah.
Right.
Yeah, why not? Yeah.
Then the last part of this, which we have a little bit of time to talk about, is this idea of investing premiums, right? Investing capital. So Can you talk a little bit about how that works on InsurAce and why, like, what kind of things you're looking at investing that in to increase the returns of the capital providers?
Yeah, I think let's say to use our premiums or our free capital. So I think I would like to introduce a concept of free capital. So it doesn't mean that each and every piece of capital in your capital pool can be used for staking.
Sure.
Sorry, used for investment. Because
Sure.
you would always need to reserve some for the potential claim payouts.
Right.
But on top of those reserves, the excessive amount of capital, which is called free capital. So these are the capital you can use for investments. So I think the top priority for this investment is always that the safety of the funds is on the top of the top priority, right? So what we can do is always invest into those low risk, secure strategies in a DeFi space, mostly like linear borrowing on Compound or Aave, or doing staking on Lido Finance, for ETH 2.0, or some other kind of reliable investment strategies. So because we need to safeguard, we cannot just people used to ask me, hey, why not use your own insurance, to protect your investment portfolios? But that actually doesn't work for us because we cannot use our own money to insure ourselves, right? So we cannot either I bought some insurance from other DeFi insurance protocols, which is doable, or I have to secure the funds myself. So that's actually a big challenge for us. So I think that's the first step of our investments. I think for the next step of our investment portal, we are kind of something like we just discuss about the integration with like Uniswap or like Harvest. So what we can do is that we can work together with those protocols. We can open a portal or an entry on our page, so people can do yield or staking from our page. But in between, we add a default layer of insurance. So of course, you have you have a number of different DeFi protocols where you can get yields, but those are not insured. Those are not secure. So you can definitely do it from us. So any investment, any staking you do well our portal, can be considered as insure. So I think this is something that we can do as well. Yeah.
Interesting. And in terms of like capital versus capacity versus the ability to write, like what are you seeing as your biggest constraint? Is it the number of people who want to actually buy insurance, or is it the amount of capital that you have available to write the policies? What's the thing that's the biggest challenge right now?
I would say, yeah, I think to get capital is definitely something challenging because, especially at the early stage of the protocol, so you will have to, give people high APYs to attract the TVL, because there are a bunch of crazy APYs,
Right.
protocols with great APYs are up there. So you will have to, outperform those protocols so you can get the capital coming in to do the insurance underwriting. So in this way, there is kind of a dilemma for us. So let's say if you give crazy APYs, then you will have to release quite a lot of tokens, which will increase your sell pressure in the market, and then your price will just essentially drop. Then with with a lower price, you will have to release more tokens. That is actually creating a endless negative loop. So I think that's kind of a challenge, and to attract capital come in, but it's very essential for us to bootstrap the whole protocol. Yeah, so let's say with a certain amount of a capital in place, we can start to sell the insurance. So it doesn't mean that, let's say you have 1 million of TVL, you can just sell 1 million of covers. It's not. It's like there is kind of a leverage here, so you can leverage it up to like 5 to 10 times with 1 million of TVL or capital in your insurance pool, you can kind of sell out like 5 million or 10 million of covers. So this is something that you can potentially scale up to your business. Yeah.
Super interesting. So if people want to find out more about InsurAce, where do they go and how do they get started?
Yeah, of course, you can just visit our website at www.insurace.io, whereas you can find all about our products, all about our communities there. So I think that's pretty much everything you can find from there. Yeah.
InsurAce.io.
Yeah, insurace.io.
And the where do you spend most of your time hanging out?
I would say spend on YouTube watching the various kind of DeFi videos, and then doing farming. Of course, most of the time I'm just spending on insurance project. Doing product design, product research, building community. Marketing, and also working together with our engineers. So I myself have a technology background, so I can work together, hand by hand, with our engineers, yeah.
That's really cool. All right. Well, Oliver, it was wonderful to have you on the show. Thank you so much for your time. InsurAce.io, go check it out. Really awesome new entrance into the DeFi insurance game. And have a wonderful day.
Yeah, you too. Thanks for having me today. I think it's really been a wonderful chat here.